Welcome to the fifth episode of our Foundation series. Today, we are focusing on the essential tool for every modern investor, the Exchange Traded Fund, or ETF. We will explore how a $21.9 trillion financial revolution has fundamentally changed the way we invest forever. You will learn why the most successful investors in the world, including some of the greatest minds in history, rely on these instruments as the bedrock of their portfolios. By the end of this session, you will understand why ETFs are no longer just an alternative. They are the dominant, most efficient way for anyone, from a total beginner to a seasoned professional, to access the world's financial markets. To understand the scale of this shift, consider that global ETF assets under management reached a record $21.91 trillion as of April 2026, according to ETFGI. This industry has seen 83 consecutive months of net inflows, proving that this is not a niche product, but the primary way modern investors access the market. In 2025 alone, global assets surged from $14.6 trillion to $19.5 trillion, representing a massive 33% annual growth rate. While over 1,000 providers compete globally, the market is highly concentrated, with the top three firms, iShares, Vanguard, and State Street, controlling 59% of all assets. The power of these tools was famously highlighted in 2008, when Warren Buffett made a $1 million wager that the S&P 500 would outperform a basket of hand-picked hedge funds over the next decade. The hedge funds selected by protégé partners generated an average return of roughly 22% across those 10 years. Meanwhile, the S&P 500 returned more than 100%, compounding steadily as it recovered from the financial crisis. Buffett won that bet decisively. His key takeaway was clear. For the vast majority of investors, owning the entire market through a low-cost index fund is a superior strategy to paying high fees for professionals to pick individual stocks. Buffett's conviction in this strategy goes far beyond a single bet. In his 2013 letter to Berkshire shareholders, he famously revealed his instructions for his wife's estate, advising her to put 10% of their cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund, specifically suggesting Vanguard. Think about the gravity of that statement. This is a man who generated 4,384,748% returns at Berkshire Hathaway between 1964 and 2023. Yet, for his own family's long-term security, he explicitly advocates for skipping stock picking entirely in favor of buying the market through an ETF. The revolution officially began on January 29, 1993, when the first United States-listed ETF, State Street's SPDR S&P 500 Trust, ticker SPY, began trading on the American Stock Exchange. A team led by Nathan Most at the exchange and Jim Ross at State Street spent 5 years solving a problem that no one had cracked before: how to move 500 individual securities into a single fund wrapper, settle them in real time, and allow shares to trade on an exchange just like a regular stock. They had to compress an audit that normally takes 45 days into just 16 hours. Today, SPY holds over $630 billion in assets and remains the most liquid ETF on Earth. While they track the exact same index, not all S&P 500 funds are identical. State Street's SPY charges 0.09% and is structured as a unit investment trust, which prevents managers from reinvesting dividends or lending securities. In contrast, Vanguard's VOO charges 0.03% and is structured as an open-ended fund that can reinvest dividends. BlackRock's iShares, ticker IVV, also charges 0.03% and offers similar flexibility. It is important to remember that all three hold the same 500 companies. The differences between them lie in their legal structure, cost, and tax efficiency, rather than in the specific stocks they choose to include. In June 2026, Vanguard's VOO made history by becoming the first ETF to surpass $1 trillion in assets under management. It attracted over $69 billion in net new investor capital in the first half of 2026 alone. Since its launch in September 2010, VOO has delivered a 14.78% average annual total return over the past decade. Morningstar currently awards it a gold medalist rating, their highest, specifically citing its rock-bottom fees and accurate representation of the index. For the long-term retail investor, VOO has effectively become the default choice for gaining exposure to the largest companies in the United States. Expense ratios are critical because they compound silently over time. On a $10,000 investment, VOO's 0.03% fee costs you $3 per year. SPY at 0.09% costs $9. However, the average large blend mutual fund charges 0.73%, which is $73 per year. While these gaps seem trivial in the short term, they scale dramatically. On a $100,000 portfolio held for 20 years, the difference between 0.03% and 0.73% can erode tens of thousands of dollars in potential compounded returns. Remember, fees are guaranteed, but market outperformance is never a certainty. If you want to look beyond the 500 largest companies, Vanguard's Total Stock Market ETF, ticker VTI, is the answer. It tracks the CRSP US Total Market Index and holds approximately 3,700 stocks, covering every United States-listed company with a market capitalization above $15 million. This means VTI captures the giants like Apple and Microsoft, but also mid-sized companies like Zebra Technologies and smaller firms that may become the leaders of tomorrow. VTI maintains the same low 0.03% expense ratio as VOO, and it currently holds roughly $477 billion in total assets. Even though VTI holds nearly 30,700 stocks, it is still weighted by market capitalization. This results in an allocation of approximately 72% large cap, 17% mid cap, and 11% small cap stocks. The top 10 holdings, including NVIDIA, Apple, Microsoft, and Amazon, still represent about 39% of the fund. This is actually less concentrated than the category average of 54% for top 10 holdings found in most large blend funds. While the exposure to smaller and mid-sized companies means VTI tends to be slightly more volatile than VOO, it offers much broader diversification across the entire spectrum of publicly traded companies in the United States. For investors seeking a tech-heavy portfolio, Invesco's QQQ Trust tracks the NASDAQ 100, which consists of the 100 largest non-financial companies listed on the NASDAQ exchange. With $328 billion in assets and a 0.20% expense ratio, QQQ is the fifth largest ETF in the world. Unlike the S&P 500, which is diversified across all sectors, the NASDAQ 100 is heavily tilted toward technology. Names like Apple, Microsoft, NVIDIA, Amazon, and Alphabet account for a significant portion of the index. QQQ delivered a one-year return of roughly 42% as of mid-2026. But remember that such concentration can work against you during market downturns. To illustrate that concentration, consider that as of mid-2026, NVIDIA alone represents approximately 12.3% of the NASDAQ 100, while Apple adds another 11.1%. Just these two companies account for roughly 23% of the entire index. Furthermore, the top 10 holdings collectively exceed 60% of the total weight. This is not traditional diversification. When you buy QQQ, you are making a concentrated bet on a handful of tech giants. For those who want similar exposure with lower fees, Invesco offers QQQM at 0.15%. Alternatively, for equal weighting, First Trust's QQEW spreads all 100 names evenly at 1% each. ETFs trade like stocks, but they are built on a unique engine called the creation and redemption mechanism. When demand for an ETF rises, new shares are created. When demand falls, shares are redeemed and destroyed. This process occurs in the primary market, specifically between the ETF issuer and specialized institutions known as authorized participants. This mechanism is the secret sauce that keeps an ETF's market price locked closely to the actual value of its underlying holdings. It is also the primary driver behind the unique tax advantages that ETFs hold over traditional mutual funds. Authorized participants are large broker-dealers or market makers approved by the ETF issuer. They create new ETF shares by assembling a basket of the underlying securities, known as a creation unit, and delivering it to the issuer. A creation unit is typically 25,000 to 100,000 shares. In exchange, the authorized participant receives newly created ETF shares to sell on the open market. The redemption process is simply the reverse. The participant delivers ETF shares to the issuer and receives the underlying securities back. This in-kind exchange, swapping securities for shares rather than cash, is the fundamental reason why ETFs are so tax-efficient. This tax magic is rooted in Section 852, subsection B, paragraph 6 of the United States Tax Code, which states that in-kind transfers of securities are not taxable events. When an authorized participant redeems ETF shares, the issuer hands back appreciated stocks rather than selling them for cash. Because no securities are actually sold, no capital gains are triggered at the fund level. This means long-term investors are not hit with a tax bill when other investors decide to exit the fund. This is a major advantage over mutual funds, which must often sell securities to raise cash for redeeming investors, thereby triggering capital gains for everyone remaining in the fund. The impact of this structure is massive. In 2024, only 5% of all ETFs distributed capital gains to shareholders. In contrast, for mutual funds, that figure was 43%, nearly 9 times higher. This difference is purely structural. ETFs use in-kind redemptions to purge appreciated securities without triggering gains, whereas mutual funds cannot. Even active ETFs show this advantage. Under 2% of active equity ETFs paid capital gains, compared to 47% of active equity mutual funds. If you're investing in a taxable account, this structural difference provides a significant advantage that compounds meaningfully over time. A 2025 study by Musawi, Shen, and Velthuis quantified this edge, finding that ETF investors gained approximately 1.05 percentage points per year in after-tax returns, compared to mutual fund investors holding identical portfolios. This gain comes from tax deferral. You are not avoiding taxes forever, but you are delaying them. Because the tax bill is deferred, more money stays invested and continues to compound. Over a 20-year horizon, a 1.05% annual advantage can be the difference between a portfolio that merely doubled and one that tripled. It is a powerful example of how structure directly impacts your final wealth. Not all ETFs passively track market cap-weighted indexes. Smart beta ETFs systematically select and weight stocks based on specific factors that academic research has linked to long-term returns. Common factors include value, which looks for stocks trading below their fundamentals; momentum, which targets stocks with strong recent price trends; quality, which focuses on companies with stable earnings and low debt; minimum volatility, which selects stocks that move less dramatically than the market; and dividend growth. Smart beta occupies the space between pure passive indexing and active stock picking. The rules are set in advance, but they are specifically designed to try and outperform the broader market. Let's look at some real-world examples. The iShares MSCI USA Momentum Factor ETF, ticker MTUM, holds stocks with the strongest 12-month price trends, excluding the most recent month. The iShares MSCI USA Minimum Volatility ETF, ticker USMV, selects stocks that have historically exhibited lower price swings. The iShares MSCI USA Value Factor ETF, ticker VLUE, targets stocks with low price-to-book and low price-to-earnings ratios. Vanguard also offers pure style plays, such as VOO for growth and VTV for value. These are not speculative gambles. They are systematic, rules-based strategies backed by decades of academic research from experts like Fama and French. While ETFs are powerful, they are not perfect. You should be aware of tracking error, which is the gap between an ETF's return and its benchmark's return, caused by expense ratios, dividend timing, rebalancing costs, and sampling. Broad equity ETFs like VOO and VTI usually show minimal tracking error, but niche or international funds can deviate more. You should also watch for premiums and discounts, which occur when an ETF's market price drifts from its net asset value. For liquid ETFs, this gap is usually tiny, but for thinly traded or emerging market funds, it can sometimes reach 1 to 5%. Always check an ETF's historical tracking accuracy before investing. Remember that ETFs are not an all-or-nothing choice. A strong foundational portfolio might use VTI or VOO for core United States equity exposure, VXUS or VEA for international diversification, and BND or AGG for bonds. perhaps adding a smart beta ETF like USMV for a targeted tilt. The key is alignment. Match your chosen ETF to your specific goals, time horizon, and account type. In tax-advantaged accounts like a 401k or an IRA, tax efficiency matters less, so mutual funds and ETFs are treated equally. However, in taxable brokerage accounts, ETFs hold a clear structural advantage. Start with the broadest, cheapest option first, and only add specificity when you have a clear reason. To synthesize everything we have covered, ETFs have won because they solve three problems at once. First, cost. At 0.03%, VOO is a fraction of what active managers charge. Second, diversification. A single share of VTI gives you ownership in nearly 3,700 companies. Third, tax efficiency. The in-kind creation and redemption mechanism allows you to defer capital gains until you choose to sell. When Buffett gave that advice to his wife, he wasn't suggesting she pick the best ETF. He was recognizing that for most people, the market itself is the best portfolio. ETFs are simply the most efficient vehicle ever invented to own it. Now that you know the tools, it is time to meet the players. In our next session, Episode 6, we will pull back the curtain on who actually moves prices in the market. We will look at the institutions managing trillions of dollars, the retail investors clicking buy, the market makers quoting prices all day long, and the high-frequency algorithms executing trades in microseconds. Understanding the game requires knowing exactly who is playing it. Join me for Episode 6, where we discuss market participants who moves prices and why they do it.